Welcome to the Deep Dive. Today, we're digging into the West, ticker WST, third quarter 2025 earnings call. That was back on October 23rd. And if you saw the market reaction, well, it was pretty dramatic. A huge double-digit stock jump. People are calling it a stunning execution quarter. So our job today is to figure out exactly why. We want to get past just the headline numbers and pull out the key financials, yes, but also the strategy, the structural stuff that management's talking about. Because it feels like this wasn't just a beat, it was maybe a shift in the narrative.
Yeah, I think that's right. And you saw that narrative shift right away with the numbers. I mean, this was a clean beat, a really significant one. Non-GAAP adjusted EPS, with $1.96. You look at consensus, it was hovering around, $1.67, maybe $1.69.
So that's a beat of 16, 17%. That's pretty substantial.
It really is. You don't see that kind of outperformance every day from a company this size. It tells you something significant is happening.
Right. It suggests they weren't just, managing expectations down. They were actually executing way better than the street thought.
Exactly. And revenue was strong, too. Came in at $804.6 million. Again, comfortably ahead of the $787 to $788 million range people were expecting. Overall reported growth was 7.7%, but the number everyone really watches, organic growth, that was a very solid 5.0%.
The market definitely noticed. Shares finished up almost 11% on the day, right? On huge volume.
Yeah, triple the average volume. So investors clearly bought into the story. They felt that performance credibility was, firmly back.
Okay, so let's unpack the why then. A 16% EPS beat, like you said, isn't just about cutting costs. There must have been a powerful revenue mix shift going on. Where did the real momentum come from?
You really have to zero in on the proprietary segment, and specifically within that, the high-value products, HVP components.
HVP, that's the key, isn't it? The specialized stuff.
That's absolutely it. Think of HVP as the really complex specialized components they sell, the ones needed for, cutting-edge drugs, biologics. This is where West sells solutions, not just parts.
So that's the engine driving things.
It really is. The whole proprietary product segment brought in $647.5 million. That was up 5.1% organically. But within that, HVP components, and this is important, it's almost half the company's sales, 48%, that was the real star.
Okay.
HVP revenue was $390 million. And the growth, a massive 13.3% organically.
Wow, 13% organic in their biggest, highest margin segment.
Exactly. When that part of your business accelerates into double digits like that, it has a huge impact on the bottom line.
Right. So that explains a lot of the EPS beat right there. What's specifically fueling that HVP momentum? What are the structural drivers?
Well, there are two main pillars, really structural growth drivers. First is the GLP-1 exposure.
The weight loss drug.
Exactly. Management was very clear about this. The elastomers, the rubber components for injectables, specifically for GLP-1 drugs, are a core growth engine. They said it's now about 9% of total company sales.
9% already and still growing fast, presumably. It's not just riding the trend. It's like they're embedded in the plumbing for that whole drug class.
That's a good way to put it. They're involved in the expansion of the huge existing franchises, but also the pipeline launches, new molecules, generics coming through. Like you said, they aren't selling the drug itself, but they're selling that critical piece that makes sure the drug can be stored and given reliably. It's kind of an infrastructure play on that whole category.
Makes sense. And the second pillar you mentioned.
Biologics.
Yeah.
Revenue there was up 8.3% organically, hit $329 million. And crucially, management pointed out their participation rate. How often they get chosen for new biologic and biosimilar launches. That's trending above 90% so far this year.
Over 90%. That's a heck of a hit rate. Reinforces that premium position.
It really does. It shows they're the go-to supplier for the complex stuff.
Okay, so this all feeds into the margin story, right? Because shifting sales from standard components to these HVP components, that fundamentally changes the economics.
It absolutely does. And we saw clear evidence of that. Gross margin improved 120 basis points compared to last year, up to 36.6%. And management said that improvement was almost entirely down to that positive mix shift towards HVP.
And operating margin.
Adjusted operating margin hit 21.1%. I mean, when you're pushing 13% organic growth into your highest margin segment, it shows up very clearly on the P&L.
Okay, this is where, for me, the story gets really interesting because it feels more structural, more long-term. And that's this Annex 1 catalyst. What exactly is Annex 1, and why is it such a big deal for West's margins?
Right, Annex 1. It's basically a European regulatory framework. It mandates continuous improvement in manufacturing for drug companies, specifically around contamination control, sterility of components.
So it's regulation driving upgrades.
Exactly. This isn't West just trying to upsell customers. It's a regulatory requirement for their customers if they want to sell into the European market. And what it does is it effectively forces those customers to upgrade their components. They have to move from maybe standard solutions to these higher quality HVP components that West sells.
So wait, it's essentially mandatory revenue shifting, moving sales out of, say, a standard 25% margin product directly into West's premium, like 60% plus HVP margin category. Is that the dynamic?
That margin acceleration is absolutely the core of it. And management said they're actually tracking ahead of schedule on this. They're working on 375 ongoing Annex upgrade projects right now.
375 projects.
Yeah, and because it's accelerating faster than they thought, they actually raised the expected growth contribution from Annex 1 and related HVP upgrades for the full year. They bumped it up from 150 basis points to 200 basis points of growth.
Wow. That's a significant tailwind. 2 full percentage points of growth just from this regulatory conversion.
It's a huge structural tailwind, exactly.
But hang on, 375 ongoing projects sounds like a massive operational challenge. Did they talk about managing that complexity? You know, the risk of bottlenecks or delays derailing this great story?
That's a really important point, and they did address it sort of indirectly by highlighting the recent strengthening of their executive team.
Ah, the new hires.
Right. They brought on a new CFO, Bob McMahon, and a new CTO, Devesh Mathur. Both started back in August. Bringing in a new finance chief and a new tech chief right now suggests they're very focused on managing this complexity. They're investing the operational muscle and the financial discipline needed to handle this HVP acceleration, especially with Annex 1.
Okay, that makes sense. It's about building the internal capability to match the opportunity. So, connecting the dots there. Now let's talk future confidence. Given this performance, the strategy, how did they update the full year guidance?
Well, their confidence definitely showed through. They raised the guidance significantly. Adjusted EPS guidance got a big boost, now $7.06 to $7.11. That's up quite a bit from the old range of $6.65 to $6.85.
That's a pretty aggressive raise.
It is. And sales guidance was also lifted, now $3.060 to $3.070 billion.
Right.
It really reinforces that feeling that the underlying trends, GLP-1, Annex 1, they're accelerating.
Okay, but then looking just at the fourth quarter, the implied organic growth guidance seemed, well, surprisingly low, only about 1.0% to 2.3%. That feels a bit weird given all the momentum we just discussed. What's the simple explanation for that?
Yeah, it does look odd at first glance, but it's purely an accounting thing, not a real slowdown in demand. It's all about lapping.
Lapping, meaning comparing against last year.
Exactly. They're comparing against Q4 of last year when they received a big one-time $25 million incentive fee, probably for hitting some major contract milestone or something. So that $25 million artificially inflated last year's Q4 revenue number. When you compare this year's expected Q4 against that inflated base, the real underlying growth, like that 13% in HVP, it looks much smaller on paper.
Oh, okay.
That fee alone reduces the calculated organic growth for this Q4 by about 360 basis points. So if you mentally add that back, the underlying momentum is still very strong.
Got it. So the demand's still there. It's just the year-over-year math is skewed by that one-off event last year. That's important context. Did they give any early hints about 2026? Any headwinds or tailwinds you should know about?
They did give some early color, which is helpful. The main headwind they flag is the planned exit from a continuous glucose monitoring, or CGM, contract. That's in their lower margin contract manufactured side of the business. That contract ends mid-2026. So it creates about a $40 million revenue headwind, mostly in the second half of next year.
Okay, so a $40 million hole to fill.
Right, but they sound pretty confident about refilling that capacity, and likely with higher margin HVP business over time, to transition. And offsetting that, there's a key tailwind, the ramp up of their new Dublin facility, specifically the drug handling part of that business.
Ah, the Ireland facility.
Yeah, that's expected to add about $20 million in revenue in 2026 and then really ramp towards full potential in 2027 and beyond. So they're essentially trading out a lower margin contract for brand new high margin capacity in Dublin.
Okay, so managing the portfolio actively. If you put this all together, the GLP-1 wave, the Annex 1 mandate, the big guidance raise, the new leadership, it really feels like the narrative shifted. Earlier in the year, there were concerns, maybe some contract pressures. Now they're talking about selective offense.
Absolutely. And the market clearly rewarded that clarity and, frankly, the execution discipline. That 10% plus stock jump happened because investors saw, I think, three key things. One, proven execution this quarter. Two, clear visibility into that GLP-1 revenue stream. And three, that almost mathematically certain structural margin boost from Annex 1.
And they're being disciplined with spending, too.
Yeah, that's important. CapEx is guided at $275 million for this year, focused heavily on HVP, as you'd expect. And management repeated that long-term, they expect capital intensity to get back down to that 6% to 8% of sales range. So focusing the money where the growth and margins are best.
And the analysts certainly took notice. We saw price target hikes from KeyBank to $350. Evercore ISI went up to $390, Buffet to $370. The street seems to be buying this execution and margin expansion story.
And it's a multi-pronged margin story they're telling. It's not just the HVP mix. They're also focused on efficiency, improving scrap and yield rates and optimizing their overall facility footprint, although that's probably a longer-term thing beyond 2026. They're trying to pull multiple levers.
Okay, which brings us nicely to our segment, This is Not Financial Advice. We've laid out the facts from the call, but we always like to throw out, and let's call it outrageous but plausible trade idea based on the specifics we just talked about.
All right, well, if you look at this purely through that margin lens, the most compelling angle is that kind of guaranteed margin divergence being driven by the Annex 1 regulation. So maybe the outrageous but plausible trade is a relative value play. Go long WST, and short, a legacy supplier, someone who's focused almost entirely on the standard lower margin components, maybe even a basket of those kinds of competitors.
Okay, long WST, short, a standard component player. That's the core rationale there. Why that specific pair?
It really hinges completely on that 200 basis point growth contribution from Annex 1 that West is getting. Remember, that's driven by regulation. It's not market share game in the traditional sense. It forces customers to shift spending away from standard components, the ones in that, say, 20-30% margin bucket, and move it directly into West's high-value 60% plus HVP margin bucket. So the competitor who only sells standard stuff, they just lose that revenue and margin.
Yeah.
West gains the high margin equivalent. It sets up this structural divergence, almost like an arbitrage, where West benefits directly from regulation driving margin expansion, while the standard guys potentially face headwinds.
That's an interesting thesis, using the regulatory shift as the core of the trade. Okay, so to recap our deep dive on WST's Q3, a really clean beat, an aggressive guidance raise fueled by both that GLP-1 demand wave and the mandatory Annex 1 conversions driving that high margin growth, and a leadership team that seems focused and executing on tilting the whole portfolio towards HVP.
And just the usual reminder, of course, nothing we talked about today is financial advice. We're just breaking down the public information from the company's earnings call and what management said.
Right. So we'll leave you with this final thought to chew on. We know GLP-1 growth is huge right now. Maybe it doesn't show signs of slowing yet. And we heard Annex 1 conversions are actually accelerating faster than expected. Could those two powerful structural factors eventually push West to consistently grow faster than that historical 7% to 9% long-range target they mentioned on the call? Something to think about.